What's good, y'all? Welcome to the first episode of Peep the Portfolio here on Money Talks with Mar. Probably have my face up here somewhere, whatever. This is just a dive into what I personally invest in. So I'm gonna go be running through my portfolio, my personal portfolio. This isn't the like I have a Roth IRA and a 401k and and investments like that, which are geared towards long term. So it's like I'm just in monthly investing and then not even looking at it. It doesn't exist. It's just growing in the background. But this is a portfolio that I started a couple months ago that I want to actively manage and kind of learn on my own, even though it's still pretty safe. Like I'm choosing ETFs, but once I master that, I'll probably start going into individual stocks or trying to find individual industries that I like more than others and learning how to trade options and swings and stuff like that. But this is just the beginning, just getting my feet wet. So my first order of action is to kind of show you my investment strategy right now, my risk tolerance and all that. So I'm 24, turned 25 in about a month, so shout out me. My current risk tolerance, I would say, is medium to high, even though, as you'll see, some of my portfolio holding, most of my portfolio holdings for now are rather safe. I just want to do that so I don't lose a ton of money on the upfront of learning. But I would say I am a little medium to high risk, especially when it comes to like, I call them IRL investments. Like, even though you're investing in the stock market, that's in real life too. But by IRL investments, I mean like real estate or investing my time or investing money into education or books or things that I want to learn. That's my version of IRL investing. And I'm very, very risky, very, not risky, but very adamant on that side of my growth. So on this side, I'm kind of just like I'm saying, taking my time, learning. Don't want to blow all of my money away, but I understand that mistakes happen. Second order of business is to just read you off what I'm currently holding. Each week I'll upload a video and I'll go through each holding, kind of explain the stock or the ETF or whatever it is. Explain what I like about it, explain what I look for in a stock, and kind of just show you like, hey, this is what I'm doing. Maybe you want to do it too, but none of this is financial advice. Do not trust a random dude through a screen. I am a random dude through a screen. Do not trust me. Always do your own research. Go into your own risk profile. Make sure that you're comfortable and knowledgeable in the things that you're putting your money into. Don't just trust me or anybody else on the internet. That being said, I'll run you through my holdings. So my current holdings are SCHD, which is a Schwab dividend ETF. That's the one that we'll be talking about today. SCHH, which is a Schwab, U.S. REIT, which if you don't know what a REIT is a real estate investment trust. Number 3 is NVIDIA. Number 4 is JEPQ, JEPQ. That is a NASDAQ premium income ETF. Number 5 is VXUS. Number 6 is VDE, which is not internet, energy ETF. Intel, that's an interesting run. When we get to that week, just hold on to that one. Just hold on to that one. If you know, you know. Number 8, Berkshire B, kind of self-explanatory. Warren Buffett, why not? Even though he is retiring soon, I feel like his principles will continue to hold strong in that company. So just gonna see how that goes. And that's been a long time holding for me, even outside of this new portfolio. But any portfolio that I have, Berkshire will probably be a part of it, not gonna lie. And then number 10 is all of my crypto holdings into one. Currently, they include Ethereum, Bitcoin, XRP, XLM, and a few others that are very small positions. With that being said, let's start off the first video. Got my trusting notes here. First holding and my largest holding is SCHD. Put it right up here. So SCHD makes money by investing in profitable businesses that are also increasing their dividend over a year-over-year basis, right? So what is a dividend? A dividend is a small portion of money per share that you earn from the company. They pay you pretty much just for owning and investing your money into that company. You can do this on an individual level, or like me, investing in an ETF like Schwab, SCHD. It allows you to invest in a bunch of them at a time, so you can kind of get an average, and if some are a little higher than others, it'll average out so you still get a decent return over time. The beautiful thing that I love about this is it's 100 plus US companies, all with a 10-year plus dividend increase. So it's showing the dividend growth. Maybe it's a little low right now, but this is, for me, especially for me, a longer term play, mid to long term play. So I really want my dividends to to compound, which allows me to, one, take advantage of the drip method. If you don't know what the drip method is, it's just not reimbursements, dividend reinvesting. So every time I get paid out, whether it be monthly, weekly, quarterly, whatever the case may be, as soon as I get a dividend payment, I put it right back and buy even more SCHD. So I might get, right now it's probably like 10 cents. But over time, obviously I grow 10 cents to $1 to $100 to $1,000 to $1 million, whatever the case may be. But as soon as that dividend touches my bank account or touches my buying power, I go right back in and re-enter on these SCHD. I do not take that money out and go spend it. Also, a pretty cool thing about this ETF is it's not actively managed, but it's rebalanced on a year-to-year basis. So there's a yearly rebalancing once a year, and they'll reevaluate all the stocks and all their holdings that they have. And if they notice that, hey, this person has decreased their dividend by a lot, or hey, this person isn't serving a dividend this year or this quarter, they'll remove them. So like, it's not like you have to be actively watching every holding in that ETF. That would defeat the purpose of ETF. You don't want to be so invested into doing that. This is great for bull or bear market, just because, like I said, every year is rebalancing. So you'll get an opportunity to kind of take out if someone's getting rid of their dividend, or they'll add in more or better stocks with higher dividends or higher growth potential for their dividend. This is also a quality versus and sustainability play. So they're not just picking the highest yield out of each company or each industry just because they have a high yield. They want history. They want, dividend kings or dividend aristocrats, those 5, 10, 15, 25 years of dividend increases every single year. They want to see that history. They're not just putting you up because, you have a 10% dividend this year, but the next quarter or the next year, it's they don't serve a dividend at all. Like, you don't want to do that. Also, all of the companies that are in SCHD have a minimum of a 5-year dividend growth. So that just reinforces that they're looking at that history. Again, they're not just picking up any high yield stock that just dropped this year or whatever the case may be. They want that history and showing like we're committed to paying our investors, our shareholders. So the biggest companies, some that are in the top 10 of the SCHD holding, you remember it's like a basket of stocks. Their biggest hold right now is Lockheed Martin. Some other ones are Altria, Chevron, and Coca-Cola. So like all big names, all companies that have been around for forever and probably will continue to be around for forever. And they all increase their dividend year over year. There's also very, very, very low fees to hold this ETF. It's 0.06%. So that's basically almost nothing. Very good ratio in terms of investing and how much you're actually investing and you will return in the end. SCHD almost every year averages a year over year return of 11 to 12%. This is almost mirroring the S&P 500, which is typically around 8 to 10%. So maybe in some cases a little higher, maybe in some cases a little lower, but the averages are roughly the same. So you're not sacrificing too much growth on the comparison to the S&P. You might sacrifice some growth when it comes to maybe if you were to win on a really big individual stock play or something that's a little more riskier. But for those people that want to take their time, they may not have a ton of time to research individual stocks. This is a great way to also grow your portfolio value while also reaping the benefits now instead of having to wait until retirement. And this is a great, great, great cash flow compounder. So if you're like me and you want to invest your cash flow that you want to use in maybe 20, 25 years, so you can maybe piece together a little early retirement, or you can dial back on your career and really choose and pinpoint your passions and the thing that you actually want to work on, because you don't necessarily need to rely on that paycheck, because you have something like this portfolio, this dividend investment and income investment strategy to help you have that cash flow every month. So like I said, it might be small, maybe only 10 cents now, but if you continue to DCA, dollar cost average into this over the next 10, 20, 15, or 10, 15, 20 years, that number is going to grow, your dividend is going to grow, your monthly payout is going to grow, and eventually you can start taking that off to live off of. And then finally, some drawbacks, like nothing's perfect, nothing is without risk, any of that. So you won't see a bunch of big tech stocks in this just because they focus more on the dividend growth and not necessarily on the value of the stock growing over time. So they want to see that payout increase rather than that stock price increase. And if you see NVIDIA's stock price, SCHD stock price, you'll see that it's not necessarily the same graph as NVIDIA where it just goes up and to the right. It's growing, but it may be a little more flat just because they're focused on giving you the cash flow and the income now rather than saving all that value and seeing the stock price grow. Because then you don't have to sell to realize that profit. I can start receiving the benefits of my investments without having to sell and taking that capital's gains tax. And then the final drawback is no global exposure, especially in a time like this where markets might seem a little volatile. You may not know where to invest your money. You kind of want to be covered across the board, very diverse. It has that drawback because there is no international exposure. But like I said, every week I'll come back, give you one of my holdings in my portfolio. Currently, they're sitting around 10. Unless you include the crypto, then there's 3 or 4 more in there. Excuse me. But 10 holdings. Each week I'll come back, explain the holding, explain why I like it, and why you should maybe like it too. Again, no advice from me. This is a random dude through a screen. Trust your instincts. Do your own research. Trust your risk tolerance. But yeah, this is Peep the Portfolio with Mar. Hope to see you next time. Like and subscribe.